This is Annie. She lives in Hong Kong. Annie is a talented entrepreneur and dreams of selling her new line of phone cases online. Annie has to develop her e-commerce app, buy supplies, manufacture the phone cases, and deliver them to customers, which would cost about $100,000. The problem is, Annie only has about $20,000 to put into her company, leaving an $80,000 shortfall. What can Annie do? She decides to trade some ownership of her company for the cash she needs. The ownership she is giving to new investors in exchange for cash is called stock. Stocks are pieces or shares of ownership of a company, and all the shares equal the total value of the company. Annie decides to invite 8 friends to invest $10,000 each to raise the $80,000 she needs, which means she will give up 80% of her company. Now, Annie owns 20%, and each of her 8 investors own 10% of her company. 3 years later, Annie's company is booming, now one of the largest phone case sellers in Hong Kong and worth $1 million. Annie secured the money to grow her company without taking on additional risk by taking bank loans. Annie's investors are happy too, because they turned their original $10,000 investment into $100,000. Just like Annie's friends bought shares in her company, you too can buy shares in publicly traded companies like Apple, Facebook, and Nike. Investors can buy and sell shares of public companies on the stock market. If the company grows, the value of the shares generally goes up. If the company underperforms, the value of the shares usually goes down. It's a good rule of thumb to only invest in companies whose products and services you understand and to take a long-term investment horizon.